Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Friday, January 6th, 2023. It's now the 5th. We start off in the S&P 500 daily chart in DeMark looking back to December 2021. I'll zoom into the current area now. And things are getting mighty tight for the S&P 500 within this consolidation zone. And it has printed the combo and sequential buy setup at one count, and to negate that for end of day on the 6th, there must be a close above 3839.50 for the price flip to the sell setup count 1 again. The 50% qualified momentum down was printed today. And to get the confirmation bar for end of day on the 6th, there must be an open lower than this close, tick lower than this low on the 3rd, and close below this close for the 5th at end of day on the 6th. And this ongoing demand line will become qualified if there's an open below, and the ongoing demand line will become qualified with an open below this close for price on the 5th, and then close underneath the demand line at end of day on the 6th. And the demand line for the 6th will be at 3813.36. And if this qualified momentum down for 50% becomes confirmed, that will also qualify and confirm this trend factor down 1 and the trend factor down 2. And if that happens, it's a given that we'll go back and test the trend factor down 3, and then possibly the channel 3 low, and beyond that maybe even. And if the non-farm payrolls report comes in decently under 263,000, somewhere under there, further down the better, but I don't believe it's going to be under 200,000 as MarketWatch has here. And then the 50% disqualified momentum up could possibly become qualified with a close above that for end of day on the 6th. And in doing that, that would also qualify this ongoing supply line. And here's the NYSE high-low chart, the NY high-low over here. And it had a valid crossover of the 5 EMA above the EMA 10 in red here. And it was valid in the ROC 12, as the ROC 12 is at negative 0.52 for the crossover. And here's its counterpart, the NASDAQ composite high-low chart, and a high-low here, and it had a crossover above the 10 EMA by the 5 EMA in blue, but the ROC 12 was at positive 6.10 when it crossed over, so that's not valid and did not get a vertical dotted line here. I give it a plus or minus 5 for the ROC 12 to become valid, so that's out of it by about a point and 1/10. And I've added the short-term and intermediate-term KSTs. You can see the short-term crossed above its signal line and is above 0. The intermediate-term wants to go above its signal line but is well below 0. And the long-term KST has crossed under its signal line well above 0, whereas the NYSE high-low, the short-term KST, is above 0, and the intermediate term KST is below zero, and wants to cross over its signal line maybe. And the only difference between the two companion charts is the long-term KST has not gone under its signal line yet. And you can see back here in March there was two crossovers to the upside, and they came in after a short dip and then move up, and then another short dip and a move up. So the same thing could happen here. And what the short-term and intermediate-term KSTs are telling us is, there might be more upside for value, I would say. You can interpret this as, but don't get used to it, because the long-term KST will eventually go under, depending on what happens with the non-farm payrolls report in the morning of the 6th. One could start thinking about the pair trade, consumer discretionary XLY versus consumer staples XLP. Right here you can see that this low just about nailed the COVID crash over here and bounced up a little bit, and that could be considered a low risk trade. And if it gets under that COVID crash, which is at about 1.648 for the ratio, you could exit that pair trade then. But going long XLY and short XLP might be okay, depending again what happens after the non-farm payrolls report. And for Thursday on the 5th, it wasn't very friendly here. So the ADP employment report, which I disregard these days, came in and look at that, 235,000 versus 127,000 the last report. And that will more than likely get revised way down because of the Christmas and New Year's hiring. But yeah, that was very high there. And the initial jobless claims came in less than the last one, and that's not good. And the continuing jobless claims fell 1.69, 1.72 million last report. So let's see what happens on Friday with this non-farm payrolls report. Last report was 263,000, so anything under that, maybe between these two, would be okay. And again, I believe MarketWatch gets their survey from the Wall Street Journal, so anything under 263,000, as long as it keeps moving down, that will be okay, I guess. If it goes above this, such as over here and there, going under, then we better wait on that pair trade. And looking at the relative rotation graph that Julius de Kempener invented, thank you, Julius, you can see the XLY consumer discretionary is trying to get out of lagging and maybe into approving and then into leading, and XLP has come out of leading and is in weakening. So if we get the rotation, XLP into lagging and XLY into leading, then we really have something there. And here's an example for justification and even thinking about that pair trade. Procter & Gamble, and their price to earnings ratio is at 25.27, and price to book is 8.1. And yes, granted, Tesla has been having its problems lately, but their PE is at 27.91. The S&P 500 support and resistance big board chart shows the gray areas at the daily conversion line, the pivot point, and the ongoing demand line. And price in the aftermarket hours for the 5th at 5:59 p.m. Central Time is 38.14 for the S&P 500. So to the downside is S1, the uptrend line from 09/24/2020, the weekly channel 3 low, and the bottom of the cloud. To the upside is R1 and then R2. And get past that, then we're back attacking the Pikeman line here, which today they regrouped and formed an even stronger line. And the big gun moved up here. The baseline 26 bars back at 38.89 is right in line with the 100 simple moving average. And they were all waving bye-bye to price as they retreated. And price never really even made it to the 38.70 zone and retreated these last couple of days. So that's a formidable resistance line in front of the Fortress Fed resistance here at 39.06. We still have the 50 simple moving average there. The top of the cloud 26 bars back concerning the lagging line. The qualified supply projection, daily high channel 3, and the weekly baseline. And for those of you who are unfamiliar with the lagging line, it's right here, and it's 26 bars back from the current bar today, and you can see the close equals the lagging line. And here's the baseline, and this is actually the strongest line that interacts with the lagging line for support and resistance. So the baseline is at 38.89.25 for the 6th, and you can see it's designated as the 30th back here. So the next formidable support and resistance concerning the lagging line here is the top of the cloud and the bottom of the cloud. The conversion line is okay, but it's nowhere near the force that it is for the baseline. So we'll fade the market if it ever makes it up into this 38.70 up to 38.90, preferably around the 38.90 area, right before the 3900 Fortress Fed resistance here, 50 simple moving average. There will be good shorting opportunities all along the way there, and if it just doesn't revisit that area, if this becomes confirmed tomorrow, this 50% propulsion momentum down, it's qualified now. So if that becomes qualified and confirmed, and we get under the ongoing demand line and get that qualified, not necessarily confirmed, that would be for the bar on the 7th, but I'll take a qualification of that and a qualified and confirmed of this here, and I'll consider shorting right then and there. Maybe not as much as I would up here, and just in case it does get through there and start going back here, it won't be as painful having those shorts down there and everything in the red. And then we'll just add to the shorts here and here if it makes it up there. And the S&P 500 daily AD line went back under its 21 EMA signal line, so it spent 1 day above its 21 EMA signal line. And the New York traditional McClellan breath oscillator to get back to zero would require 1,136 decliners over advancers to get back to zero. So that's still above zero for now, and that's a good sign. Have a great day.